We are looking at NUBURU Inc., ticker symbol BURU, as the market is currently closed on this Thursday, May 28, 2026. The stock closed its last regular trading session at exactly 19.58 cents per share, which marks a significant intraday jump of 6.30% on the day. Now, when you see a penny stock sitting at less than 20 cents, jumping by over 6% in a single session, the immediate expectation from the broader retail crowd is that this is just another fleeting pump and dump scenario. People assume it is a typical micro-cap flash in the pan driven by day traders on modern investing sites looking for a quick flip. But the reality under the surface is far more calculated and structurally complex than a simple social media hype cycle. While the typical retail crowd is busy looking at standard meme plays on their favorite online investment platforms, NUBURU just executed a legally binding share purchase and investment agreement to lock down a 70% majority stake in an established Italian defense contractor called Tecne. This is not just a nominal partnership or a vague memorandum of understanding. It is a massive structural play valued at a pre-money figure of 52 million euros, with total commitments potentially reaching up to 64.6 million euros. This massive acquisition completely alters how we have to analyze this tiny company, shifting it away from its historical industrial laser roots and slamming it directly into the lucrative world of international electronic warfare, directed energy defense, and military mobility. The market has spent the last year treating NUBURU like a dying microcap penny stock that was on the verge of being completely wiped off the NYSE American Exchange due to a massive stockholders' equity deficit. The expectation was total capitulation. If you open up the Robinhood app or scan through your individual brokerage account balances over the last 12 months, anyone holding this asset watched it lose more than 77% of its value, cascading from a 52-week high of $4.24 all the way down to a brutal low of 15 cents. When a stock falls that hard, the common ground consensus among retail traders on popular online investing apps is that the business is structurally broken, completely starved of cash, and toxic to hold. People assume the listing non-compliance indicators next to the ticker symbol mean the final curtain is drawing shut. However, the contrarian reality that forced a massive spike in trading volume this week is that the management team has quietly engineered an aggressive balance sheet restructuring. They just reported their first quarter financial results, showing a complete reversal in their foundational equity structure. They wiped out a staggering $15.2 million stockholders' equity deficit from the end of last year and pushed it back into positive territory at $2.17 million. Suddenly, the narrative of inevitable bankruptcy is clashing directly with an aggressive cross-border expansion plan that is currently awaiting official regulatory clearance under Italy's strict strategic asset protection laws. Let us unpack the exact mechanics of this price action, because the trading volume tells a fascinating story of institutional positioning versus retail skepticism. Throughout the middle of May, the stock was completely dormant, grinding sideways near the 18 to 19 cent mark on incredibly thin volume. The lack of conviction was obvious. No one wanted to touch a company facing a weak financial health score and negative gross profit margins. But the moment the binding agreement with Tecne was finalized, trading volume exploded to over 25 million shares in a single session. This massive surge in liquidity indicates that sophisticated capital pools are beginning to notice the sheer scale mismatch between NUBURU's tiny $35 million market cap and the massive forward revenue projections of the asset they are acquiring. According to the binding business plan filed under Italian accounting standards, Tecne is projecting cumulative revenues of approximately $655 million between now and 2030. When you do the math on a 70% pro rata ownership basis, that represents an economic share of roughly $459 million in projected top-line revenue for NUBURU, assuming they close the transaction and execute the industrial plan perfectly. That massive variance between a $35 million market valuation today and a $459 million forward revenue pipeline is precisely the kind of asymmetric tension that creates explosive volatility in the microcap space. Please take a brief second right now to share your thoughts down below. Comment below how many shares of NUBURU you currently hold in your portfolio, or if you are entirely avoiding microcap defense plays in this current macroeconomic environment. It is always highly valuable to see how many people are actively tracking these ultra-low-priced equity turnarounds. When you look across the broader competitive landscape of the market, whether you are tracking massive blue-chip tech names like Tesla stock, Apple stock, or Nvidia stock, or managing a highly diversified basket of assets through automatic allocators like Schwab Intelligent Portfolios, the fundamental metric that drives sustainable institutional accumulation is always clean, compliant capital structure. NUBURU has been playing a dangerous game with exchange delisting rules for quarters. The NYSE American Exchange requires a minimum level of stockholders' equity for companies that have sustained consecutive years of net losses,
and NUBURU has been flagged with a non-compliance indicator for quite some time. The expectation was that the company would be forced to execute massive, highly dilutive reverse stock splits or face outright delisting to the over-the-counter pink sheets. But the reality delivered in their recent preliminary financial disclosures reveals that they managed to boost their total assets to over $76 million, rapidly moving toward the higher $4 million equity threshold required by the exchange to regain full unconditional compliance. This structural cleanup is the prerequisite that allows institutional funds to even consider looking at the stock, as most institutional mandates strictly forbid purchasing equities that carry active non-compliance tags or trade below exchange minimums. To understand how this company arrived at this critical operational juncture, we have to look back at what their original business model actually entailed before this massive pivot into international defense systems. Historically, NUBURU built its entire identity around developing and manufacturing high-power, high-brightness industrial blue lasers. The core engineering thesis was that blue laser light possesses a physical absorption rate that is significantly higher than traditional infrared lasers when working with highly reflective metals like copper, gold, and aluminum. In practical application, this meant their proprietary technology could produce faster, significantly higher quality welds for electric vehicle battery manufacturing, consumer electronics, and aerospace components. They launched product lines aimed directly at capturing a massive slice of the global automated welding and industrial additive manufacturing markets. But the commercialization path for hardware engineering is notoriously expensive and slow. The company ran into a wall of severe cash burn, posting deep operational losses, struggling with a negative gross profit margin, and leaving liquid assets completely dwarfed by short-term obligations. They were essentially a pure research and development shop trying to survive in a high interest rate environment where the market had absolutely zero appetite for unprofitable microcaps. That commercial frustration is precisely why the strategic pivot into a dual-use defense and security integrated platform is so critical to analyze. Instead of just trying to sell laser components to automotive factories, management realized that their underlying directed energy and high-power blue laser intellectual property had massive utility in modern warfare, specifically in counter-drone operations, non-kinetic weapon systems, and secure communications. They quickly established a production phase joint venture with Maddox Defense to build mobile manufacturing platforms designed to print drone and defense components directly in the field. This tactical shift immediately began to show up in the numbers, with the company recording its first meaningful revenue generation of roughly $407,000 in the first quarter, alongside an additional $660,000 in active billings and $500,000 in executed orders. While those absolute dollar figures are small, the change from generating zero commercial revenue to establishing a legitimate multi-segment defense pipeline represents a profound shift in operational velocity. As we look toward the forward horizon, the entire near-term trajectory of this equity relies completely on a massive regulatory catalyst that is playing out right now in Western Europe. Because Techne handles highly sensitive critical infrastructure, electronic warfare, and military mobility programs for European defense networks, the transaction cannot simply close upon the signing of a private contract. It is subject to intense regulatory authorization under Italy's Golden Power framework, which grants the Italian government special powers to restrict or place strict conditions on foreign investments in strategic national security assets. NUBURU is currently finalizing its formal notification package to submit to the Italian government. The company has spent months engaging in pre-filing discussions with government representatives to align its industrial plan with Italy's sovereign strategic priorities, attempting to de-risk the regulatory approval process as much as possible. If the Italian government grants unconditional clearance, the path is clear for NUBURU to convert over 17 million euros of existing shareholder financing into equity, execute a 12 million euro capital increase, and assume absolute majority operational control of the entity. However, if the regulatory process hits an unexpected roadblock, stalls out, or imposes severe operational restrictions that limit corporate consolidation, the downside risk to the equity is incredibly steep. NUBURU has already funneled a massive amount of its available capital into this entity, including 13 million euros back in January and another 3.7 million euros in March, alongside an additional commitment to provide another million euros immediately following the signing. For a company with a market cap sitting right around $35 million, having that much capital locked up in a cross-border regulatory approval pipeline means they have pushed almost all their chips to the middle of the table. If you are a self-investing individual managing your own risk via active trading tools on platforms like Interactive Brokers, or checking your long-term allocations on legacy systems like Fidelity Investments, you have to recognize that this is a high-stakes binary event. The market is currently pricing in a moderate level of optimism, but the ultimate reality of the regulatory decision will dictate whether this stock breaks out past its persistent 20-cent resistance level or suffers a severe pullback. When we synthesize this entire landscape, the stark contrast between market expectation and underlying operational reality becomes completely clear. The general market narrative still views this ticker through an outdated lens, treating it as an unprofitable, highly stressed industrial laser component manufacturer that is constantly fighting off delisting notices. But the deeper corporate reality reveals an aggressive, rapid transformation into an international defense platform that is tying its financial future to a massive multi-hundred million-dollar European military contractor. The capital structure has been intensely reorganized to restore positive stockholders' equity. The product pipeline has pivoted to high-margin defense joint ventures, and institutional trading volume has clearly awakened from a year-long slumber. The risks are undeniably real, driven by tight short-term liquidity, negative historical profit margins, and absolute dependence on foreign regulatory approvals. Yet the sheer scale of the potential forward revenue integration compared to the current microscopic market valuation creates a compelling setup that demands close attention. It's a classic example of an asset undergoing an extreme identity shift right in front of the market, where the final outcome will be determined not by past financial struggles, but by the precise execution of their new international defense roadmap. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video? Comment your thoughts. Share with your friends. Subscribe for more updates.